Hi, I'm Serena, and I'm the lead market analyst in Asia. And I'm joined by Emma, who heads our China market analysis. In this short video, we'll be discussing the reasons for the steep reduction in China's second batch of product export quota that it recently issued and the implications to both China and the wider Asian market. So this week, the China National Development and Reform Commission, or NDRC, issued a second batch of product export quota of 7.5 million tons to its state-owned refiners as well as independent refiner Zhejiang Petrochemical. And this batch of product export quotas are down 75% compared to the first batch that was issued at the start of the year. Now, to put things into perspective, how deep the cuts are, Chinese refiners exported over 22 million tons of clean products in the first half of 2021. And this batch of 7.5 million tons of product export quota only represents about 1/3 of the total clean product exports made by the refiners in the first half of this year, which means that going forward, the Chinese refiners have to significantly reduce their product exports. And this has major implications to both the Chinese refiners in terms of their refinery runs, as well as the wider Asian market balances. So to start off, Emma, could you share with us the reasons why there is such a deep reduction in China's second batch of product export quotas?
Sure, Serena. There are several reasons behind the export quota cuts. The main reason is government's efforts to rectify refining industry and to control carbon emissions. The independent refiners and oil blenders have imported and processed more than allowed amount of crude oil and blending components in the past year, which has intensified local market competition and pushed state-run production to export markets. Now the government is cracking down on these private players by imposing a series of regulations. These include the recent consumption tax on blending components like light cycle oil, mixed aromatics, and diluted bitumen, and levying value-added tax on jet fuel if receiver is not aviation firm. The government has also reduced crude import quotas to independent refiners and tightened resale of imported crude from state-run refiners to independent segments. So all these new regulations are in turn helping state-run refiners to regain market share from the independent players. And by reducing the surplus refining capacity in the country, it fulfills China's aim of reducing air pollution and carbon emissions. The other reason is higher domestic margins compared to export margins. The domestic wholesale prices for gasoline and diesel have risen sharply in May, right after the announcement of the consumption tax on blending components. The export margins, however, is much weaker compared to domestic margins, which have encouraged refiners to keep supplies within the country. And in fact, Vortexa data shows China's clean product exports have declined a month since April, and we saw its gasoline plunging to a 30-month low in June. So the combined effect of tighter regulations and stronger domestic margins is likely to keep China's product export lower in the second half of the year. And a decline in product export quota for the second batch is not a surprise.
It's really interesting, Emma. So what implications would the reduced export quota have on Chinese refiners going forward?
We can examine the impact on state-runs and private segments separately. Besides JPC, there's no new independent refiners issued export quotas in this round. And the independent players are facing reduced crude import quotas and intensified competition from the state-owned refiners. So they are likely to cut refining runs and to reduce crude purchases in the second half of the year. And for the state-run refiners, of course, the refining margin is improving because there's less supply from the independent players, especially from oil blenders. However, the product export quota cuts are so deep, despite stronger domestic demand in Q3, they may still need to reduce refining runs and import less seaborne crude in the second half of the year. So overall for China, the product export is going down and the crude imports are also likely to go down. And this will also impact the freight market. We can expect a lower VLCC and clean MR and ERA tanker ton-mile demand in the second half of the year. So Serena, how do you think the reduction in China's export quota is going to impact the oil market outside China?
Well, I think first of all, Asia will see tighter clean product supplies as a result of lower exports from China, and this would support regional product cracks and refining margins. In fact, we have already seen this effect in the gasoline market, where China's gasoline exports plunged to a 30-month low in June, continuing into July, and that lifted the gasoline cracks in the region despite the rising crude prices and demand weakness in the region. So from this perspective, China's cutback in its clean product exports is definitely a bright spot for regional refiners. And going forward, as demand recovers, the rising product cracks and refining margins will incentivize and encourage regional refiners from South Korea, Taiwan, and India to increase their refinery runs and raise their product exports to Asia to fill the gap left behind by China. And in the months ahead, we may also see India, which currently exports more than half of its clean products to other regions, diverting more supplies into Asia if the arbitrage prices in the Asian import markets prove to be more attractive compared to other regions. Now, if that happens, we could see a knock-on tightening impact on the Middle East as well as West of Suez markets as a result of lower supplies from India. With that, we come to the end of the video and we hope that you have enjoyed it. We welcome you to reach us at vortexa.com. Thank you.